Hello and welcome to another episode of Ken Training, where we want to teach you the training that you need to tackle projects like this one on your own. Today's project is training. The training is going to be on what to do when your stock is called away because the option was exercised to take your position away. Okay, so here's what happened to me. This was in my personal portfolio. I had GLD, which is a gold ETF, precious metals allocation category or asset class, shares taken away from me on 10/4/21. Today's actually 10/3/21, but on my brokerage account, the transaction will take place tomorrow morning, Monday morning, first thing. And the option that I had was at 164.50. My issue was that I was trying to get cute with my option. And let me explain let me explain to you what I mean by that. Let me go over to the chart GLD, and this is GLD right here. And what happened is that GLD, this was a few days ago. This is on Friday's trading right here. But over here on this candlestick was a few days ago, and GLD was reaching a bottom, and I wasn't sure exactly what was going to happen. I didn't think GLD was going to get beyond this point here. So I had a covered call with my position, but I had it with a strike price of 169, and it was so far away that this option was pretty much, I could buy it back for just pennies. So I did. I bought to close my option for pennies on the contract, and I sold to open another contract with a 10/1 expiration date at 164.50. And what happened was on Friday when it closed, GLD closed at 164.59. This not on Friday's action, but on Thursday's action, it just popped. I couldn't believe that it popped like that. It was an extremely bullish day on Thursday. So what happened was it kind of took me by surprise, and it took out my option. And when I purchased GLD, I purchased it at somewhere around 170 a share when I purchased those shares. So at 164.50 on the share price, I'm taking a loss on the shares. Now this happened to me in a taxable account. And let me go back to this. So what happened was this was in a taxable account, and I had a loss on the shares taken. Now I want to take advantage of the tax loss that I received on the shares. In order to do that, I cannot buy GLD for the next 30 days in order to avoid the wash sales rule. And in case you don't know what the wash sales rule is, I copy and pasted it right here. The wash sales rule was designed to discourage people, just like me, from selling securities at a loss simply to claim the tax benefit. Well, that's exactly what I want to do. I want to claim the tax benefit. A wash sale occurs when you sell a security at a loss and then purchase the same security or substantially identical securities within 30 days, before or after the sale date. Now, we're talking after the sales date, because I already had the shares. The shares are going to get taken away from me tomorrow morning. So what am I going to do now, mind you, when I trade, I like to trade within a portfolio. Now, let me show you what I mean by that. And hang on one second here. This is my model portfolio that I did on an earlier video. The video was titled Wheel Strategy with a Diversified Portfolio. You can check out my channel for that video. But in that video, I have a allocation. Hang on one second, right here. So this is how I do the allocation. It was a $200,000 portfolio, and in that portfolio, we tried to do 4 positions in large cap equity ETFs, which is SPY or large cap stocks. That's the S&P 500. 50,000 in bonds, 50,000 in real estate, and 50,000 in precious metals. In this case, gold and/or silver. Now, I had gold in my own personal portfolio, which got taken away from me. So my gold portion um, of the allocation here got taken away. Now I want to put it back. So what are my options? The options are right here on what I can do. I can sell a cash secured put with an expiration date greater than 11/4, and I can sell, or option 2, I can sell a cash secured put on another precious metal. And I highlighted that because that's the option that I'm going to take on Monday. Option 3, just buy another precious metal other than GLD and write a covered call on it. I don't like that option. Option 4, buy and or sell a combination of precious metals, ETFs, and options, which is not a bad strategy to diversify within your precious metals allocation. Or number 5, just not do anything. Just hold your precious metals allocation in cash because everything just looks ugly. And I'll be honest with you, the precious metals category does look ugly. When you look at stock charts and you look at GLD, it is traveling down. This is on a daily chart. When you look at GLD on let's just look at it on a weekly chart. Hold on one second here. Go to 046 GLD on a weekly. You can see that you have a total downward bias. There's a little bit of a bottom here, so we're inside of this trading range on GLD on a weekly. And you look at SLV, even on a weekly, SLV is totally, which is, by the way, the silver ETF. On a weekly, you can see that we're in this downward trading bias. And until this line gets broken, until that happens, you have not officially changed direction. Now, I like to use a couple of moving average or momentum indicators indicating what's going on with the momentum. And the top one here is the MACD, moving average convergence divergence. Now we're below the 0 line, which tells me we're starting to get into some value here, but we still haven't changed trend yet. We haven't even bottomed on the MACD indicator, but we have just bottomed on the slow stochastics indicator, but we haven't crossed the signal line yet. And we haven't even gone above 20. So we need all this to take place in order to show that SLV, silver, has reached a bottom. But from a valuation standpoint, I'm liking this one better than the valuation on GLD on the same chart. You can see we're kind of, this GLD is acting stronger, but SLV took a bigger hit. GLD is holding up better. I got to admit that it's holding up better than SLV, but all the precious metal categories are just weak in general. Here's some other precious metals right here. Here's GDX. Look at that downward bias. This is the gold miners, total downward bias. You have to break this top line to change trend. And the next one over is the junior gold miners ETF. Same thing. So this is all within the precious metal family, and they're all looking not great, okay? But I'm liking SLV because it looks like that may hit a bottom right there. Now, looking at my calculator, what I did was I ran a couple of different options, okay? One of the options that when I was showing you this here, you could sell a cash secured put on GLD with an expiration date greater than 11/4/21. Looking at the calculator on this line item right here, I did exactly that. Basically, not that line item, excuse me. It is going to be this line item right here. So what happened was on 10/4, which is tomorrow, we could purchase or sell to open a cash secured put against GLD, the same one where the shares got taken away, with an expiration date of 11/5/21. That's a 32-day trade, gets you outside of the wash sales rule. So you would be avoiding the wash sales rule. When you sell to open this option, you're not buying the shares, you're selling an option. So you're not going to get hit up with the wash sales rule on this if you were to make this trade. it would give you an 11%, 11.2% annualized return on investment. Not a bad return on investment with 3% of downside protection from its current price. But I weighed that against silver. The same silver contract going out to the same date 11/5 would yield you a return on investment of 20% with greater downside protection, 5.6%. But I found a better option or cash secured put to sell to open. And this is the one I'm liking the best. It's the silver is the ETF. We're only going to go out to 10, 15, 21. It's only an 11-day trade, but it is not the same ETF on the shares that got taken away. And it's not even, to my knowledge, I don't even believe the SEC would consider SL or the IRS to consider SLV to be substantially similar to gold. It's a completely different metal. So you have a huge argument that that's it's substantially different. So as far as I know, the IRS would not say that you don't have a valid wash sale non-transaction here. So by doing this transaction, you only have an 11-day trade, and you're going to get a nice hefty 25% return on your investment. Now let's look at that on a chart. Looking at that on the chart, this is where SLV is currently trading. This would be our new proposed options expiration date, and that would be 10/15/21, and we would have strike price of $20 a share, which is right here. And so if this ETF gets to here and below that, and you have some, and by the way, and you have some downside protection, let's look at that. So if you were to get the one that I'm looking to get, your break-even costs when you're starting to experience a loss would be at $19.85 a share. Let's go back to the chart, and let's go ahead and see where $19.85 is. $19.85 is right about there. So it has to go all the way to right here before you start to lose money on this trade. And from our current trading price all the way down to that point right there is about 4.5%, somewhere in that neighborhood. So you have definitely some downside protection. And I believe that that would be the best position for me to take to maintain my portfolio allocation, which is what I'm trying to do, is maintain my portfolio allocation 25% into precious metals. So that is going to be the best one. Now, I also did one other thing for you. I went to Thinkorswim's trading platform and I plugged in the exact numbers to see what the Chicago Board of Options Exchange says about what the probabilities of the trade being in the money is. So here is your option expiration date, 10/15/21. Your strike price is at $20 a share. The probabilities of being in the money is 23.86%, which means that you have a 76% probability with the option expiring out of the money for a profitable trade, which means that in 11 days, it's an 11-day trade. You're not going to own the shares. Your shares are, the option is going to expire worthless, and that's it. But there is a 24% probability that this will come down, you'll get traded, and you'll be executed on this trade, and you'll own those shares. Either way, you've got the money in your account. It's a cash secured put, meaning that you're holding the cash in reserves in your account. So when you look at the trade, it tells you right here that the cash required to do this is $49,000, which gives you gets you at your $50,000 allocation. And you're going to get $375 for making this trade. So that is, in my opinion, this is the way to go for your allocation. Okay, that is going to conclude this video. I hope that you got some tips and tricks on how you can take advantage of the options in order to maintain your asset allocation without actually owning the position. And the cash secured put is a wonderful tool that you can use in order to do that. This video was intended for training purposes only and not to be construed for trading advice. Get that from your own financial advisor. Smash that like button down now. Subscribe to my channel, Ken Training, and I will catch you on the flip side.